Now, the European segments have been a little light. That's going to continue. We get a decent amount of data actually tomorrow. So that'll provide us a bit more to talk about as we go into next week, because it's also going to give us kind of an indicator of where did December close out. How are things shaping up as we go into Q1, and that's going to be I think the biggest importance as we go forward, because you're looking at this. A lot of this is looking at things from a November perspective, which, as we said in November, things were going to be slow. And then they were, again, stayed slow in December, but then you saw a little bit at the end of December getting a bit better and actually having a nice little bump in January, especially on the construction side. So when we look at the survey expectations in January, as we were saying, things got a bit better. Prior were 26.8, came in at 49.4. That's something that we think is going to remain elevated in a good position. As the construction output came in light, coming in at negative 0.2%, and then construction output year over year coming down to 0.5%. So again, you're starting to see that slowdown, which continued through December, but then we did see some of that loosening up in January. Inflation expectations. So inflation expectations have gone through a floor in Germany, with the Eurozone headline inflation still remaining elevated. There's a view that, as energy prices normalize, and that's why, 6 months out, that as energy prices come down, you're going to see a massive reduction in inflation. Now, some of that is true. I am by no means saying that a drop in natural gas and gasoline won't have a meaningful impact. I just think that it's overestimating what that impact's going to be, because you still have construction delays, you still have car delays, you still have pressures on a lot of different goods in terms when we'll look at where, I should say, as we said in segment one, the amount of delays on the coast still remain elevated and is actually getting worse, which again is creating some additional problems, and that's going to drive up prices as well, which is keeping things a bit problematic. But when you look at European households, will pay 54% more on average for energy this year, and this is the increase in 2022 versus 2020 levels. So this is for the year. So when you look at those inflation expectations still going out through the next 6 months, this kind of flies in the face of what we're seeing and what we're experiencing in that market. Now, as natural gas prices went up, you had facilities closing down, cutting runs. So by doing that, you also increase the underlying cost, because if you're not producing it locally, you'll have to import it. And imports are inherently more expensive. So, that's also going to drive up pricing. So that's, even if you get a big, nice move down in some of these energy costs, there's still a lot of residual impact that's going to keep that inflation fairly sticky. And here's another thing, reason why: house prices. So home prices and rents in the EU, home prices continue to go up, and that's where, as we've been saying, we expect rents to continue to drift higher and move closer to where home prices have gone. Also being some of that key driving aspect behind not only just inflation, but sticky inflation. Inflation that isn't going to go away anytime soon. And it's important as to where, because when you look at the overall European Union, the Euro area, they're all moving higher. Now, Germany is one of the biggest ones when you're thinking of the strongest economies. So that's where we continue to see some of these pressure points, some of these issues when we're looking at inflation, where yes, you will get a move down, but things like this are going to keep it a bit more elevated than I think what the expectations would be and what the views are. And that will put pressure on where that economic growth can really go to. So then when you look at the GDP side, GDP for Germany came in, expectations 2.7%, came right in along those lines. Survey expectations were expected at 32, came in at 51.7. Current situation came in at was expected at negative 8.8, came in at negative 10.2. So people are concerned right now, but they're expecting a quick rebound. Now, a quick rebound would also be inflationary. So that's when you look at some of the different backdrops. And when you look at now there's been an increase in car manufacturing. So that is a positive. You've had an increase in car manufacturing, but there's still a backlog. So you still have some of that additional capacity, which is a positive. They're waiting for, obviously, semiconductors. That's still taking a long time. And then you have, again, inflation pretty much holding right in line with estimates were. And we don't see that changing as we go into January and February. So then 4 out of 5 German companies complain about supply shortages. So this is also going to keep prices elevated. And you're seeing those delays and those backlogs remain in the second largest ports in Europe, which again is going to just be a big driver for some of these different pain points. So the German owner-occupied housing price, continued to drive up, which is why, again, when you look at inflation expectations, this is what we look to when we're trying to speak about sticky inflation. So current situation, you can see kind of where things were, but that nice little bounce in expectations. They're still not back to where we were pre-Omicron and the election, but we are seeing some movement. Now, obviously, I think there's going to be a bit of a pause when you look at the pressure points between Russia, Ukraine. What is that going to do for consumption and for just where energy prices are? And that's going to be, I think, a key one to watch in terms of expectations going forward. Now, when we switch gears a bit to France, so manufactured goods core CPI contribution, you can see that the core CPI contribution continues to rise. Now, manufactured goods continuing to go up, and as manufacturing slows due to cost, that relies more on imports, that slows down economic growth and jobs. And again, these are all of these key pieces that I think are going to lead to inflation not having this big snapback, but really coming off highs, obviously, but not coming to the level that I think is the hope and belief in the market, which then is going to result in some additional rewrites. Now, Italy, on the other hand, industrial production was expected at 0.4, came in at 1.9%. For November, same thing for year over year, expected 3.7%, came at 6.3%, still remaining fairly strong. That's something that also slowed down in December, but we did see it increase in January, providing some of that uplift when we're looking at Italy. So, but then when you look at Omicron right now, Italy, Google trips to retail and recreation as a percent to normal on 7-day average, you can see a big step down. We think that's going to continue in some of these regions in terms of just some of that fear. Again, not so much a huge drop in activity, but just avoidance. Like, let's not take excess risk. And that's something that is going to continue to permeate throughout Europe, also leading to additional numbers getting taken down. Now, when we look at the UK has had record inflation. We've seen them get more aggressive on raising rates and guidance on rates, while the ECB continues to maintain, I think, some of their slow pace of rate rising. Now, the German yield is back above zero, so you're seeing negative debt, or I should say negative yielding debt going away. Real yields still negative, but when you look at nominal rates, they're now positive. You're starting to get some of this concern, and I think that's really going to drive the ECB into more action, especially because I think there's a misconception as to where inflation is going to be. It'll slow, but not to the expectations of both the ECB and some of the economists that are putting out data on it, keeping some of those pressure points. So now that we talked about Europe, we're going to shift gears a bit, and we're going to talk about China and some of the data sets that have come out in some of the other Asian nations.